top 5 rules in personal finance. Notice we started with saving. Well, being honest with yourself, right? So write down keep a journal, saving, pay yourself first, live below your means, and of course, finally, use credit wisely. The second part of my talk is on investing. So after you've done all that, okay, I now have some money in the bank, I've got 3 months of savings, my credit card balances are virtually zero, I'm ready to try to invest in a way that I can actually build my financial infrastructure in such a way that I can live a better life sometime in the future. Because that's what investing is, right? Investing is I'm gonna buy some asset today for $1, and then maybe sometime in the future it's going to be worth more than $1. That's what investing is. Okay. So here are 6 ideal investments for beginners. I see a lot of young people in here. I'm assuming that many of you are beginners in the investing world. Okay. Maybe you are, maybe you aren't. I know 21-year-old millionaires. Okay. But I also know 61-year-old paupers. So this would be a way of taking a look at the very basics and investing. And I have 6 that I say: the 401k or other employer retirement plans, something we call robo-advisors. Now the reason I say robo-advisors is because I know a lot of us have this, right? And you can actually get financial advice through an app, actually several apps. I'll talk about that in a little bit. Okay? This has been a game changer, by the way. You can actually save through your phone. You could invest through your phone. You can gain financial knowledge and education through your phones. Okay, but like I said, we'll get to that. I also take a look at the third one, what we call target date mutual funds, and I'll talk more about that. This basically means, as the name implies, I'm going to buy into a mutual fund. I'm going to take the fund, I'm going to withdraw from the fund at a future date. I'm going to have a specific date in mind. Sometimes it'll be a date of my anticipated retirement. Okay? So you go out 30 years from now, that kind of thing, perhaps. Index funds, that would be, again, I'm going to talk about this in more detail in a little bit. An index fund is nothing more than, as the name implies, you invest in an entire index. And those are really low-cost funds to invest in. Exchange-traded funds, ETFs, you might have heard of that expression, ETFs, that's what exchange-traded funds are. I mentioned the S&P 500 average return over the last 90 years at 9.8%. You could invest in the S&P 500, okay? And I'll talk a little bit more detail. And various investment apps, okay? Now I know, usually talking in a university setting in front of young people, I have to talk about apps, right? Tanika talked about apps for FAFSA, right? You can you notice if it doesn't exist on the phone, it doesn't exist, right? That's how it is these days. Okay, so what's a 401k? I also put the 403b here because 403b is similar to a 401k, but for not-for-profits, okay? And for example, university, we have a 403b plan here at Purdue Northwest. Here's what I would really recommend. Take advantage of your employer's retirement plan if they offer one. If they don't offer one, there are alternatives, and I'll get to that towards the end here. Right? If you have a 401k, that's really the first place you should probably put your money. Why is that? Well, one reason is that it's more often than not automatically taken out of your paycheck. Remember I said automate your saving. Okay, you can have money taken out of your paycheck. Your employer very often will match in some way what you take out. Okay, so if you take out 10%, your employer may match at 10% or 50%. Every employer has a different plan. So certainly check with your HR department if you have one and see what their plans are like. Incidentally, you can contribute up to $19,000 a year in your 401k. This is tax deferred, by the way. I think we're going to hear something about that later. So you don't pay taxes on that $19,000 if you're going to put it in the bank. Now you'll have to pay it later. In theory, when your income is lower, you'll be in a lower tax bracket. Incidentally, if you're 50 or older, this isn't working. If you're 50 or older, you can put up to $25,000 a year. Try to catch up, that kind of thing. But start young. And why do we always say start young? Why do you think we always say that? Compound interest. Albert Einstein once said that the greatest invention of mankind was compound interest. Because it's interest upon interest upon interest. Use time to your advantage. Okay? Somebody my age, if I said, well, I'm going to start a savings plan, well, I only have so much time to do that, right? But somebody your age, this is the time. This is the time to save and take advantage of compound interest. If you have a 401k where you work, please take advantage of that. Same thing with a 403b, works the same way. Okay, the beauty of this is that there's rarely an investment minimum. You can put in $1, or you can put in nothing. Some employers will just simply pay into it, and that's part of your compensation package. Sign up for this as quickly as you can. Learn about the plan. Contact your HR department. I mentioned the concept of the robo-advisor. What's a robo-advisor? Well, as robo implies, is something that you're not talking to a human being. Okay? Robo-advisors are now becoming quite mainstream. If you're looking for low-cost financial advice, again, you can do it through your phones, there's a number of online advisors, and they charge very little money. You can see here, they tend to charge about 1/4 to 1/2 a point, or 0.5% of your account balance per year. And many allow you to open an account with no minimum or virtually no minimum. Okay? And so, again, educate yourself about these. You can do some research on these and then figure out what's best for you. Notice, you're going to see a trend here, and as I'm discussing this. First of all, what does it cost you to open up a 401k? Nothing. Okay? It costs you nothing to do that. Okay? What about the robo-advisor? Very low cost. Okay? I'm a huge fan of keeping your expenses as low as possible, especially in the beginning. Now, once you become what we call a qualified or accredited investor, the belief is that you are savvy enough to be able to make really good, sound financial decisions. Have you ever heard of that term, the qualified or accredited investor? You ever heard of that? All right, well, to be a qualified or accredited investor, according to the SEC, the Security Exchange Commission, you have to have at least $1 million in assets that is not your home, not the home you live in, and or earn $200,000 a year. If you can do that, then you're considered an accredited investor. You can invest in certain things. It is illegal for certain funds to allow you to invest in them unless you are an accredited investor. That would be hedge funds. We're talking about high return funds, those sorts of high return investments, because with high returns comes high risk, and the belief is that if you have accumulated $1 million and you're making $200,000 a year, you're probably savvy enough to be able to do the research and really make a qualified investment decision. But getting back to this, I'm all about keeping your expenses down, because those high return investments tend to come with higher fees, right? And so you're paying for that. If you're interested in learning how to invest, but you need a little help getting up to speed, these robo-advisors can help you there. And again, you get some advice, and go to more than one place, okay? Don't take all your advice from one person, except for me, of course, but I said I'm not giving advice. Target date mutual funds. Okay, a target date mutual fund, as the name implies, I said this before, you actually have a target date of when you're going to pull the money out. Okay? So, for example, here's something that's kind of interesting. Typically, a manager, because whenever you buy a mutual fund, you're really hiring a manager to manage your funds. Okay? So, what you're doing is, you may have an equity fund where they're going to buy stocks for you. And then you're going to say, well, I'm going to pull these stocks out in 10 years. And so that fund is only going to be 10 years old, 10 years in duration. Here we go. Here's the third bullet here. If you plan to retire, let's say in 30 years, right? So let's say a 30-year-old wants to retire at the age of 60, you would choose a target date fund of 2050. in the name. They have target, by the way, target date funds have the target year in the name generally. Okay? That fund will initially hold mostly stocks in the beginning and then kind of move away from stocks towards bonds. Why would we do that? Stocks tend to have higher returns than bonds generally. Okay? Stocks are also more risky. Right? Think about stocks. When you buy a stock in a company, you're buying part of that company. So the profits of that company is going to determine the value of your stock, right? And so the profits go up and down all the time. So it's a little bit more volatile. Okay, so therefore it's riskier, therefore you need to demand a higher rate of return. Now, younger people can overcome this. Why? Compound interest, right? You can make it up. Somebody like me, I have very few stocks right now. I have some, but I have very few stocks. Why? Even though I'm going to live to be 200, right? I want more of a return of my money than a return on my money at this point. Okay? And a lot of people in my situation feel the same. And so what happens is that the manager knows this, so towards the end of the 30-year period, they would transfer some of the assets from stocks to bonds. Index funds, I mentioned these before. Index funds are like mutual funds on autopilot, right? You don't hire a professional manager, you can actually buy directly into an index fund. Usually the first time you're going through a broker of sorts, but all you're doing is you're tracking a market index. And here's an example of an index I said before, the S&P 500. And like I said, over the last 90 years, you've had a return about 9.8% on average every single year. Some years are higher, 15.5%. Some years are not so high, okay? But on average, 9.8%. Index funds can have a minimum investment requirement. Some brokerage firms offer various selection of index funds. The S&P 500 is not the only index. You can actually buy the Wilshire index, which is the entire stock market, okay? But you still have to go through a broker initially, but then you just let it ride. Kind of what you do. The fees are relatively low because there's very little hands-on management of an index fund. So they don't charge very much money for it. Exchange-traded funds. Now we're going to start to see a little bit higher fees. Not very high, but a little bit higher fees. This time instead of an index, you're actually trading in a particular exchange. An example of this would be, an exchange traded fund that does track the market index. So it's kind of a hybrid of both market index and other mutual funds. So what we see is sometimes the minimum now is a little bit higher. The fees are a little bit higher. You see what I'm doing here? The fees are getting progressively higher as we're looking at these different investment vehicles. Now, I said before there are investment apps. And you just simply go to the App Store and you can actually do a search for investment or saving apps, that sort of thing. I'm actually kind of a fan of Acorns. Acorns is one of those things where it allows you to round up a grocery bill, let's say. And what you do is you round up. Now, of course, what happens is the difference automatically goes into a savings account. And then eventually, if you build up a certain amount of money, it automatically goes into an investment account that you decide. Right? Again, automate as much as you can. Now, I didn't include individual retirement accounts in my top 6 yet. And the reason I didn't do that is because I often say, if you're going to invest, let's say, in an ETF, before you do any of that, the first thing you should do is open up an individual retirement account. Don't make me dance. Okay. Right. I say that to my students all the time when they have their cell phones out and they have the funky songs on there. One time it was, they recorded me dancing and that never happened again. So, anyway, individual retirement accounts can be broken up in basically two different types of accounts. Traditional, what's called a Roth IRA. They allow you to save $6,000 a year. It can be pre-tax or post-tax. But you save $6,000 a year, again, $7,000 if you're 50 or older, even if you're contributing to a 401k or other workplace plan. What's the difference between a traditional IRA and a Roth IRA? A traditional IRA, the contributions are tax deductible. Okay, so you put your $6,000 into the individual retirement account, And the retirement account can be made up of almost anything. It can be made up of mutual funds, stocks, combination of the two. You can have what's called a self-directed IRA. That's a totally different seminar on how to do all those. And so we don't have time to do that here. And I see my time is getting a little short. But anyway, it's pre-tax, right? So what it is that it's totally tax deductible. Now you won't owe income taxes until you withdraw from the funds. Okay, and you withdraw from the funds without penalty, after age 59 and a half. Before that, you have to pay a penalty and a tax. So the idea is to keep the money in there. The Roth IRA, the contributions are not tax deductible, so these are post-tax, contributions. But you can withdraw the money tax-free in retirement. So again, check with your tax planner, your tax advisor, your financial planner to find out which one is best for you in your particular situation. Going back to what I said before, saving and investing plans are driven by each individual's goals. There are no two people alike, therefore your plans are not going to be alike. But the key is to plan, communicate with your partner if you have one, or communicate with yourself, being honest, okay? And then just simply have the discipline to stick with it. Ladies and gentlemen, that is my presentation on saving and investing. Do you have any questions for me? She listened to me. You can see that right here. She has money in her pocket. Thank you very much.